So he's bringing a closed-end fund, so raising some permanent capital, as Wall Street loves to do these days. And as part of that deal, they're distributing shares of Pershing Square proper, which is the hedge fund, which manages the strategies. So that deal is expected to price tomorrow. My colleague Anthony Hughes broke that they're expecting to price it at $5 billion. Keep in mind, a few weeks ago when they launched this process, last week when they launched this process, they said they would raise $5 to $10 billion. So at the bottom of that range, and if you think back 2 years ago, without the sweetener of the hedge fund, they wanted to raise $25 billion. That ultimately was pulled. So this has been a few years in the making, but it does seem like we'll cross that finish line tomorrow.
Which part of this offering do investors want more, the closed-end fund or the exposure to the hedge fund?
Hedge fund. I mean, closed-end funds historically, or at least recently, have traded at discounts. The London market, where he currently has a closed-end fund, trades at a wider discount than here in the U.S. But just for reference, that right now, according to our data, is at a 32% discount. So you're talking about buying something that, if you have the long-term vision in Bill Ackman and Ryan Israel and the team at Pershing Square, you can buy it now and you hold on to that closed-end fund for as long as you want, and you at least get access to Pershing Square, the management company, in the interim.
Is that discount, that 32% discount, is that bigger than typical?
Yes.
So why is that? Why is he getting a discount? Why is he having a hard time pushing out this deal in the U.S. market?
Well, it's wider because these things are more thinly traded in the UK, in Europe. So that's one part of it. It's also the fact that these are essentially going to be identical products. So if you're an investor, why would you not cut a check today to get in at least at NAV and then get the bonus shares? I mean, the counter argument is, why would you not buy something that's 32% on sale, which is also fair. The other argument, when you talk to folks in the closed-end fund space, is the only reason to get an incremental buyer is someone who believes in the vision going forward.
So define for us what a closed-end fund is. Everyone knows what an ETF is. Yep.
It's essentially that, except for you can't withdraw your money. So if you buy, you participate in this at $50, you can sell it in the market. It's like these BDCs and other products that are permanent capital. You buy it, you can pay the sticker price, if you will, but you don't get access to what the underlying assets actually are worth. So if you buy at 50, it trades at a 10% discount. You turn around and sell it at $45, you lost $5. But if you buy the Pershing Square London deal at a discount or buy it today, you don't necessarily care about the discount. You just care where you can turn around and sell it in a minute, a day, a year.
Just remind us again about what Bill Ackman's investing thesis is, because he was one of the most vocal activist investors. We can all remember Herbalife and what he tried to do there and didn't get done. But he's not really pursuing that path anymore, is he?
No, he's become kind of a relatively taking a longer view, I guess you could say. I mean, the counter argument is he has exposure to Brookfield. He has exposure to Howard Hughes, which has been a big position in the company. Also loves the technology companies. Amazon, Alphabet has been backing and tweeting ad nauseum about Fannie and Freddie and what they can bring.
Yes, always.
So not necessarily your old school activist where you come out with some reports and go head to head with management. Now kind of taking a longer view. And again, the counterpoint to from some investors is, if I get paid to invest money, why am I turning around and paying a fee to invest in someone else who's investing money? And when you look at the portfolio, yes, he's had some big winners and has done well in the long run, but Amazon, Alphabet, Uber, Universal Music Group, they aren't, according to some people I talk to, necessarily novel names that are kind of under the radar, if you will.
So I guess just 30 seconds left. How has his performance been? I mean, has it been...
Depending on their data, pretty good. But if you use the London-based closed-end fund as a comp relative to the U.S. market, it's underperformed on, I believe, a 1 year and 2 year. Longer out, it has outperformed. It kind of just depends where you slice and dice that. But all things considered, it comes back to the whole debate around, do you want active money or do you want passive money? It's really hard to outperform the S&P 500 right now.
Yeah, and this is going to be mostly institutional money?
According to Anthony's scoop, about 85% institutional, 15% retail. But still, if you do that math, that's about $750 million of retail money. So not a poor performance by any stretch.
Yeah.